whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. You may lose all or more of your initial investment. Opinions, market data, and recommendations are subject to change at any time. Past performance is not necessarily indicative of future results. Well, that's broad subjects that I'm going to be touching on are talking about how markets change coming into the holiday season. You get to know that traders are going to alter their behavior as well. You're going to have a situation where the liquidity is waning. It's a good time of year, as we'll talk about, for our reflection about your trading plan and to take inventory and plan for the new year. Now, 3 missteps traders make. Number 1 is failure in recognizing what we call the liquidity paradox. Quiet markets with random liquidity. It's critical to track the liquidity. It's elusive during the holidays. The volume can come and go. Liquidity disappears and appears quickly. Traders have to know some seasonal tendencies that we will talk about and discuss. And another big mistake people make is not putting their trading house in order for the next year. Now, what do I mean by liquidity paradox? Normal markets, liquidity creates an improved trading environment, able to get in and out of your positions without a lot of slippage, and the lower overall liquidity during holidays can get overwhelmed by what would be normally normal order flow, and this liquidity creates short-term panics in thin markets, or it can, or create lack of follow-through. So watching the volume, November and December in the stock market are generally a lot lower volume overall, and they don't have the fewest amount of trading days. The holiday weeks are going to be particularly thinly traded. It's time to be very careful. Only those who have to trade will be around to take the other side of your trades. Now, who isn't around? A lot of traders will go on vacation. They're going to take time off during the holiday season. Some people don't like to trade in the low liquidity markets, which can create even lower liquidity environments. Market makers, the firms who are in the markets, making markets in the different stocks, they can adjust their programs for the lower liquidity environment. They may, wide change their algorithms a little bit in order to, to change the way that they're going to make markets around these environments, and it'll change the pace and the look and the feel of the market on a day-to-day basis. Hedge funds, they may be sitting on some profits. Some of these hedge funds, if they're up a lot of money at this time of year, if they've made a good profit, they may decide to back out and just not be in, in some of these instruments that you're used to seeing them in. And trading desks, they're going to be operating with skeleton crews. Junior traders, you're going to see your bank traders, your more senior guys. They're not going to be around. They're going to be off in the Hamptons or wherever it may be for the holidays. Now, over the last 6 years, you have these quieter months. Over the last 6 years, the NYSE volume has been lowest in November or December 4 times out of the last 6. So, it's pretty it's pretty much a given that we're going to have some lower volatility coming to this time of year. Those months typically do not have the fewest trading days, as I stated. You have very quiet weeks. Over the last 10 years, the SPY has had the least volume on the last week of the year. Take a look at that. E-minis, S&P E-mini futures show a similar pattern. The week of Thanksgiving or Christmas are very low volume weeks. It might not show up technically in the futures markets. Some of these markets are going to have rollover during that time of the year, so you'll have switching of positions. So sometimes, you'll see a situation where, the volume looks like it's heavy, it looks like it's normal volume, but it's really not. There's a lot of spreading going on, a lot of roll spreads, getting in at one position and rolling your position forward. So the volume is much lower in most cases. I just pulled up the last couple of years. You can see this is the SPY, the weekly volume, and the holidays. I just put some ellipses here around the week of Christmas. You can see both the last 2 years. Trust me, you go back any time period, you're going to see the same thing. You can see just how much lower the volume is. And again, I picked the SPY due to the fact that we didn't want to take a look at the futures and and it would, you might have the appearance that there was actually some greater volume. You see in the QQQs, the same thing, highlighting the week of, in this case, the week of Thanksgiving and the week of Christmas. You can see that, just how low the volume can be. Now, the thing is that some business does have to get done this time of year. I think we're seeing that right now. We'll look at some examples of recent market activity the last couple of days. Mutual funds, they're going to still create some flows. End of the year borrowing will need to be done. Some of these companies do their financing at the end of the year, so they're going to need to, they'll be doing some swaps or some hedging, getting their financing in order. So the treasuries or the euro-dollar markets might be very busy. Traders may be closing out positions for the year end. Some firms like to close their book down and start the year new in January, and so you're going to see some of that. And positions may be closed for different tax purposes. I'm going to talk a little bit about how that can manifest itself in some of these equity markets. This is what I call like a liquidity barrage. So you'll have liquidity or order flow, and it can come without warning. This mutual funds need to get some business done, or like I said, end of the year financing. Some of this stuff has to get done. And order flow in thin markets could create a cascade of prices. So you're going to really want to pay attention to situations where you see outsized volume coming into the markets. This is a point where you may want to to step aside and let that take its course. Immediately joining it can help you survive. If you see the volume coming in waves, either get out of the way or you're going to want to go with that. I would recommend just sidestepping it all together. You see here volume collapses in the price index futures. Just pull this up as a random part chart last December. I said it's not hard to find this stuff around the holidays. You can see throughout the day here, through some ellipses on this early on, you can see where the volume was pretty low most of the day. Then you have an awful lot of liquidity coming in at the end of the day, just stepping on prices. That's the kind of thing that a trader will have a very difficult time recovering from, is these big outsized price movements, because you really, it's unlikely that you're going to be able to catch another wave like that, the rest of the day, or going on for several days. And I call this fooled by good luck. Right? The random order flow. If you're used to working a lot of orders, used to working a lot of positions, you may be in the order book, maybe working some option positions or some futures or some stock positions. Maybe like to try and buy on the bid or sell on the offer. Now you're going to find yourself all of a sudden getting a lot more positions than you're used to, and you may feel like you're getting some edge there. You're buying on the bid or you're selling on the offer. You want to be very careful with that. Traders, you might be tempted to take on some extra size or some shares because you're getting the edge, and you may not be used to getting the edge. So trading full units can be costly. It may seem too easy to get an order flow, as I said here. It probably is. If you're getting hit on too many of your orders, you probably shouldn't be in there. And one of the things that you always want to ask yourself is, when you put a trade on, is how will you exit? Who will come in and take the other side of your trade? If you've bought some stock or some options or some futures, who's going to come in and push the market in your way? Is there enough traders around to create that situation? A lot of examples I pulled up here. Completely flat volume, late December, and these are the kind of markets you can expect. Here's more of a normal, what I call a volume smile in the index futures. You can see the differences here. Let me toggle back and forth. You can see here that we've got a flat line of volume almost the entire day. We had a little volume come in at the end of the day, not unlike the last example. This is normal volume. You see a lot of volume coming in early in the session, quiet down for possibly around lunch or midday, and then a ramp up in volume again at the end of the session. So you want to adjust your size for liquidity. So quieter markets with low liquidity can create a trap. Order flow can be, can leave traders with partial fills or larger than normal, over a larger than normal range. The bid and offer spreads can suddenly widen, leaving traders without any way to exit the trade. And that's what I was talking about before. All of a sudden you're getting hit on something, the bids fall out of the market, and you've got no place to exit. Now here's just a typical day. I pull up in oil futures. You see that we have these trending markets, nice swings both directions. You see the volume profiles on these, on this particular issue. And again, here is last December. Again, I just pull up some random charts this time of the year. You see where the volume is very, very spiky, inconsistent at best, and no direction to these markets. Again, normal Q action, QQQs. Lots of volume, lots of movement in the markets. This is a holiday market. You see where the volume is flatlining through the most of the day. You have a little bit of volume in the beginning, at the end. You can see it as the as the ranges. We have maybe a little bit of movement and then flatlining for the rest of the day. These are the kind of markets you can expect. Tactics to adjust for these conditions. I'll show you some things that you could possibly do to stay out of trouble. Okay. Oops. Sorry. Get off track here. Okay, here we go. So liquidity trap applied to trading. Okay, not only trade size, but where we trade needs to be adjusted. So we're gonna, I would recommend scaling back on your size a little, and the spots where you trade are going to need to be a lot more precise, a lot more pinpoint. Directional trading or continuation or momentum trading. Sure, you've heard these terms used before. That's the kind of trading that can be dangerous to your trading account. Wide swinging markets in the oil market, again, as we showed before. Tight ranges, low moves in December, lots of false moves. Lack of range late in the year. Okay, normal price movement. I've got just used some technical tools that I like to use in my trading. On the bottom of the chart here, I've got the MACD, the MACD, moving average convergent divergence oscillator. You can see here I've put these ellipses on places where our momentum has picked up. Now, in normal market conditions, when we see the momentum pick up, a nice trade, a good trade, a viable trading tactic is to go with that momentum. Once we see new momentum highs and we see price highs, this is the kind of a tactic that you can use to join the market, and you expect what we call follow through. See, we've got lots of nice follow through in this market. Oil is generally a market that likes to trend. You see pretty much every time we had a push up in momentum, we had some sort of follow through. So momentum spikes, trading against momentum spikes, lack of follow through, lack of continuation. That's what we're going to see in low liquidity markets. Trading in the direction of momentum will largely be a poor strategy. This is what I call more like a faders market. It's spiky. You see that the price spikes. I've got what I've got here are Keltner channels drawn around the recent price action here. There's a short-term 5-minute chart in this market. You can see that spikes reach into the edges of these Keltner channels and is quickly rejected. So this is what I call a spiky market. These are the kind of markets that you're going to see more often this time of year. Now, last chart I showed you about with the momentum spikes was what you'd call normal conditions, normal liquidity. Now here you can see in this market we can track most of the momentum spikes and price spikes we saw were rejected. Very little follow through. Pretty much most of the tops and bottoms were set with no follow through. Right here you had one that did have some follow through. Here you had one had a little bit of follow through, but basically, these are the types of trades that have a high percentage win-loss ratio. And you can see here that through what do we have for 8 trades, I think we've had 2 that would have had the possibility of extracting yourself with a with the profit, and about 6 of them were dead in the water, never even had a chance. So that's that's a low probability environment for these types of trades. So you really want to steer clear of that type of activity. Again, just another market, 10-year bonds on low volume. This was Thanksgiving week. This was Thanksgiving week last month, just this past Thanksgiving. I pulled this chart up. Same type of situation. You see in these momentum spikes and price spikes are all quickly rejected. If you're someone who likes to jump on trends and follow it, this is not the type of time of year that you're going to be able to do very well with this strategy. Again, stock index futures. Just a further example. You've got spikes here. You had some eventual follow through, but not until we reached all the way back into the band and the complete opposite direction. So you can see in every market we've looked at oil, we've looked at the treasuries, and we've looked at stock index futures, running into the same type of situation, the same problems in every one of these markets. Here's stock index, the last 2 days. These are the last 2 days. Actually, I actually copied this into here a couple hours ago, so we actually did have a little bit of a run up in the afternoon. Truth be told, this is the stock index futures, the E-minis, the December stock index futures. But you can see, we've had these very small ranges here. I think yesterday's range was about what I'd say like a $9 range, and we were just talking about it. And the normal range for this market this time of year, or for the past month, was about $20. It was about a $20 range. So today I think we're going to put in about a $13 range, and yesterday was a $9 range. So again, you can see it's very difficult to try and play continuation trades. So really expect the ranges to be contracted from what you'll normally see. And I think part of that is some of the stuff that goes on this time of year too, which I didn't mention earlier, is this is from today. You can see that you've got the SPY on the top panel here and the QQQs on the bottom panel. These are the kinds of situations as well. You're seeing where these markets are grinding higher or they're grinding lower. There's not a lot of swinging price action. I think a lot of that you're going to find if you take a look at the different sectors, you're going to see that that's due in a large part to sector rotation as well. I think we're getting out of some of the technology issues right now, getting out of some of the food companies. Some of the restaurants aren't doing well. You're seeing the ones that have not been doing well. People are getting out of those, and some of the stuff that's been doing better, or with anticipation of the new year and the new presidency, you're seeing certain sectors that are being acquired. Again, QQQs, drifting market. And it's not just the U.S. markets either. I pulled this chart up. This was actually from last month as well, around the holiday. This is the German DAX. So it's not just a U.S.-centric phenomenon. You can see that their products are trading the same way. We could pull up their Boon. We can pull up the stock indexes for the Euro stocks, the DAX, the FTSE. You're going to find the same type of patterns happening in all these markets, whether it be a debt market, whether it be a commodity for the most part. Of course, you saw a nice run up in oil lately, due to some OPEC decisions. But as those things become known and that information gets into the markets, these are the types of situations and the type of trading that you can expect. So what do? You curb aggressiveness. The market action will show you different characteristics this time of year. I've shown you numerous examples. Expect smaller overall ranges. Okay, back and forth trading action. Don't expect us to open on the low, end on the high, close on the high, or vice versa. Probably going to see a lot of what I call back and fill, back and forth through certain prices will be traded multiple times throughout the day. You might not see some trendiness emerge. You could, but be very careful. It's not, it's the exception. It certainly is not the rule. And your support and resistance that you're normally possibly using, be very careful. Expect a little more sloppiness in the market. expect for prices to be, challenged, to possibly traded through a little more than normal. If you like to trade the highs and lows from the previous day or the previous week, expect that you may possibly push a little deeper, beyond the prices that usually hold. So choose your trade selection carefully. Be very careful. Diligently manage your risk. The exception to not being aggressive is when getting out. If you're wrong, you really need to hit the button. You really need to get out of your trade. As I showed you in some of the earlier examples, these markets can run when liquidity comes in. If you have a big bank or a mutual fund that needs to get business done, they'll get it done. They're not gonna hold off because there's lack of liquidity in the markets. If they need to get something done, they're going to do it. They're going to have to get it done. So cut down on your daily risk limit. Trade smaller. Whatever you're used to risking in a day, I would recommend maybe you cut that in half or cut it down by a third, and have a tremendous amount of patience with the trades that you get in and your trading plan. Now, some of this stuff, I'm going to talk about some seasonal statistics. Some of it has somewhat already occurred, but coming up in December, we still have some things that we should probably be cognizant of going forward, and we're going to talk about those. So we have some powerful seasonal statistics that are present at the end of the year. November and December statistically are two of the best performing months of the year for the S&P 500, actually for the Dow as well, and the QQQs, or the NASDAQ. December is the best month, returns 1.7%. This is going back to 1950. So it's a lot of data, it's a lot of years, and that has held up for over that entire time period. So over a half a century, the December S&P 500 has been the best month. I think we're starting to see a little bit of that now. Year-end tax selling can bring some weakness. Again, I'm talking about the sector rotation again. I think that's some of what we're seeing now. Now, typically, the first 2 weeks of December is when tax selling takes place. We're going to look at a couple of graphics here, and you'll see that over the last few years, I pulled up some examples, and you're going to see that that's been the case. And the later part of December is one of the more bullish times of the year. Call it the Santa Claus rally. So after mid-month. This is just this year alone. We know after the election what kind of run-up we've had in November. So right now, November is showing very powerful tendency to be a bullish month. So far we're holding the seasonal statistics. Maybe some people missed some of the run-up, but it's certainly what we should have expected. But we still have some additional chances coming forward. So November and December. The VIX readings. Taking a look here, you can see in early December is when this tax selling has come in. Like I said, I just pulled up the last couple of years here to take a look at. You can see that that we had usually your VIX is rising in a seller's market. You can see that we had that the last couple of years. First couple weeks of December, we had a rising VIX. We're not getting that right now, which is somewhat curious. But we had a little different year this year. End of December. Now, like I said, I pulled up some charts from the last couple of years. You can see that we've had these sell-offs in in earlier December, around mid-month, and this isn't the greatest example, but we did rally the second 2 weeks into the month. So early sell-off, late rally. This is a fantastic example of where we had 2 weeks of selling. Again, probably tax selling. So we're looking for this to end around the 15th of the month. So after the first 2 weeks, you can see here, this was 2014. Like I said, I just pulled up the last 2 or 3 years. Didn't cherry pick them, just pulled them up. Said, hey, did it happen in the last couple of years? Did it happen in the last few years? And indeed, it did, to one extent or another. This is an example where this was a complete home run, not to if you were to have paid attention to this. And again in 2013, again, end of the month came right around the 15th, right around the second week of the month, and had a strong rally going into the end of the year. Again, you can look back in your data. You're going to see some years where it didn't hold up, but by and large, you're going to see that this is a pretty strong seasonal tendency that that you want to pay attention to. And just pulled this up again today as well. Last week of November and first week of December, we did see some weakness coming in, which I think it's pretty powerful due to the fact that if we look back on this data, this is the SPY. If we look back on this data, I mean, we had week here, going back all the way here, week after week after week, where we were unable to even take the lows of the previous week out. We had a little bit going on here, and finally we had this happen over a couple of weeks, and so we did have a downdraft. That one actually started a little early into very late November and certainly into the early part of December. Anybody's watching the markets, you see when we popped up a little bit the last couple of days, showing a little strength again here. But I wouldn't discount that that the selling could very possibly reignite itself to the downside. Further on into this last 2 weeks, into the first 2 weeks, I should say. So what do we have? We have tax loss selling creates a flush down. Now, what usually occurs is if you take and you look at the issues that are trading near their yearly lows, those are the ones that are usually come after the strongest. They're usually sold, the most aggressively. And so just after December 15th, expect some strength. So look for the indexes or beaten down stocks to do well going forward. Might be a nice time to take a look at some of those stocks that are in the NASDAQ or in the Qs. You can see that index is not, that thing just has not been holding up, as well as the other indexes. Granted, it led earlier in the year, but this kind of tax selling can push stocks down below, valuations which you probably wouldn't normally see. So using strategies that may exploit that tendency may be profitable. Now, this is what, the only thing that bothers me about this year is it was an election year, so sometimes we have some different things happening here. The VIX was acting out of character a little early on. The Federal Reserve stands a good chance of tightening in December, which we'll take a look at that. So the markets may not behave the same, although up to this point, they pretty much have been. I just pulled up the the VIX reading from November, and we know what this was all about. This was election driven. My only concern for this year would be that maybe we'll wash some of these stocks out a little early, but maybe not. That's just something I want to keep an eye on. I want to see if the issues that were pushed down, that are trading at at recent lows. Want to see if those things are still being sold. Like I said, my only concern is that maybe some of this washout occurred a little early because we did have a rather large flush down in the indexes, in the stocks, earlier than normal due to the election. We still have the Fed. I don't know how they come up with 100.2%, but a greater than 100% chance of Fed tightening here coming into the December meeting, which is just 8 days away. Right? It's the 14th. So that's another thing to take into consideration is, does the Fed act, do they act the way we think they're going to? Do they act the way that, that the Fed Watch tool is saying they're going to act? Is the prediction going to hold up? Do they tighten by more? Do they not tighten at all? So that's probably going to be a very important point going further, or is the indication for a further tightening cycle. Okay, just to reiterate some of the statistics, the S&P 500 starts the best 6 months of the year beginning November. That's a fact. There's plenty of bullish tendencies around. We have sayings like sell in May and go away, and buy Yom Kippur, sell Passover. These are sayings, these are truisms that have been around for a very long time. Yom Kippur is usually towards end of September, early October, so that fits right. That fits very well into the statistical data of November, December being strong months. Again, but you can expect this to go on for quite a bit into the beginning of next year. So don't get too bearish. Let's keep an eye on on the money flows into the markets and see if we're going to adhere to these tendencies. So don't fight the tape. If it looks strong, you see money flowing in the markets, probably because that's exactly what's going on. Monitor the daily conditions carefully. Okay, these are just tendencies. But we don't want to ignore them. So prepare to go with the historical strength if it emerges. If it doesn't set up that way, if we don't see the selling come in, maybe we stand back a little bit and see how these tendencies play out. It's not meant to be a system, a standalone system. And the last thing I want to talk about is take care of your business. Review your year. You should analyze your trading records for the year. You should track where you were effective, where you were not. Look and see what you've written down. You should have a journal. Find out how many times did you write certain things down. Changes take a long time to make. Have you started to make those changes? Look at the trades you made. Determine if the edges held up. If there's some types of trades that you like to make, how they held up during the year. Are they still giving you that edge? Are you still getting the return on those trades that you were normally getting or have gotten in the past? Maybe they're even better. Maybe some of those trades have even improved. You should want to know that as well. And if not, rework your setups. Find out where they're falling apart. Where they're standing up. The good and the bad. Enhance what's working, and think about getting rid of what's not working. Review your personal performance. Not only, is my trading plan, are my setups effective, but were you effective? Where were you not effective? Did you take the trades? Did you manage the trades correctly? Did you follow your trading program? What can you personally do better? Have you gotten enough sleep? Have you, are you focused enough? You letting distractions get you during your trading. Aggregate your findings. Figure out where your trading fell short. Is it entries? Is it money management? Are you over trading? Some of the other things I mentioned. Find out where, if at all, you can improve on your trading. And rest assured, everybody can always improve their trading. Is your technology, is it where it needs to be? Do you have an updated computer? Are your screens easy on the eyes? Do you have a comfortable chair? Review your tax strategies and finances. Is there anywhere you could have, is there anything you could have done to keep a little more of the money that you made? Or, did you take full advantage of possibly losses? God forbid you had any. Invest in any education or tools that may improve your performance. That could be, books, seminars, whatever it may be. Health. Okay, write a fresh business plan. Once you aggregate the findings, sit down, take your findings and put them on paper. Define a detailed strategy. Don't leave anything out. It should be numerous pages long. Even the smallest details should be accounted for. Make sure you have a timeline. Don't just say, I want to be a better trader this year. I want to be a better trader this year. That's not specific. You'll have exact things that you want to accomplish in a timeline. Once you're done doing this, know what you want to accomplish by the second week in January, by the last week in January, by the first day of spring. Have some timelines where you have details where you want to accomplish certain things. And if you're not there, get there. Create a daily routine to accomplish your plan. Get up at the same time every day, if you can, when you're trading. Work on your markets at. Either do it after the market closes or before it opens. Have a time where you work on your markets. Have a time when you accomplish your plan for the next day, and plan to succeed. Don't just I think I'm going to do this. I'm going to try and do that. Plan for success. Okay, so your holiday success plan. Manage your trades around the lower liquidity first and foremost. That's what we have going on now. Be conservative. Be focused. Be pinpoint accurate. I've pointed out some seasonal tendencies. Take a look. Let's see if those things are going to manifest themselves this year. We did have an election year. Want to be a little more careful. Revamp your trading plan. We just talked about that. Get into it. get a detailed plan, and enjoy this time of year and come back better next year and more focused. With Q&A in a minute here. Again, my name is Craig Garbie. I'm from Market Taker Mentoring. If you want to, you always want to join my live, I have a live futures coaching every day for an hour a day, daily class. I like to put out about 5 to 7 actionable future ideas every class, various types of futures contracts. Again, my name is Craig Garbie. I've been in this business for over 18 years now. Started my career on the Chicago Board of Trade trading floor in the grain room, moved to the bonds, eventually made my way over to the Chicago Mercantile Exchange, where I traded some clerked on the floor and traded currencies on the trading floor, and then moved upstairs to become what you call an upstairs trader, where I mainly focused on stock index futures, stock index spreads, treasuries, and gold, and some various other instruments over time. So in the live market, classes are every day from 10:30 Central Time to 11:30, 10:30, 11:30 Central Time, hour a day. Never miss a class. Classes are recorded. If you miss one, no problem. If you want a review, even better. I supply my email. A lot of times people ask me questions, if they want to, what kind of a box maybe they need, or something about software, trading tactics. So I don't mind answering questions. If you do join, and feel free to email me at any time. Again, special 1-month trial. Normal price is $9.97 a quarter. Get a month for $49. Go to markettaker.com/FC49 and sign up with us. Again, 1-month special, discounted monthly subscription forever. It's $199 a month for those who stay in the class. Cancel anytime. Come into class, you don't like it 2 days later. My feelings will not be hurt. If it's not for you, you are free to cancel at any time. Again, enroll here, markettaker.com, FC49. Thanks a lot. This has been a presentation of Market Taker Mentoring. Again, my name is Craig Garbie. I hope I turned you on to some interesting ideas and some things that can help your trading going forward during the holiday season. And again, feel free to check us out and join the futures trading group. Love to have you. Love to help you out with your trading if futures is something you're interested in. Everybody have a great day and have a wonderful holiday season.